yields have made a significant improvement. Could you talk to us about what's the upside which is left in terms of the translation going forward? And if you have a number of Nims in mind with respect to what could be the target for FY24?
So clearly, if you recall our previous conversations, I have said that we've started passing on the rate increase to the consumer. And we have so far been able to pass on about 75, 80 bips to the consumer. And that's one of the reason you see the change in the NIMs. I think also it's important that we've discussed about it in the past, the product mix change. So our pre-owned vehicle volumes are increasing, and they do definitely come at a different level of NIMs, and that also improves. So for us going forward is concerned, we do believe that in the next couple of quarters, we should then start seeing the rates come off. And since our lending is all fixed rate, we do believe that even going in 24, maintaining this level of NIMs should not be a major challenge unless we start seeing substantial increase continue to happen to the borrowing cost.
Mr. Iyer, your asset quality volatility has been a bit of an issue in the recent period. Do you think that we can see that reducing? What's the outlook in terms of your NPAs?
So clearly the answer is yes. And the answer comes from the two approaches that we have taken. One is we have added different segments of customers as well, and who are not expected to be so volatile. In the past, we have worked most of our books have come from the earn and pay segment. And earn and pay segment does bring this volatility because of the changing market conditions. So definitely to the extent you will see there is a stability that comes in. Two is we have put in a lot of efforts in terms of various collection, improvements to be brought in through various new processes. Maybe you call it as we've set up a collection war room, which was set up last year, and that has definitely yielded result for sure. And the third is also a product mix change that has come about. And as I just talked about the pre-owned vehicle going up, they definitely do come with more stability, because someone who's buying a pre-owned vehicle does think twice before he can really invest in an asset. So put all this together, we definitely believe that you will see much more stability in the NPA going forward. And of course, all of this also substantially depends on how the market conditions are. Currently, rural market sentiments are very positive, and we see substantially improved cash flow from the market, which is also helping us really correct the position.
Right. Your loan growth and disbursements have been strong, Mr. Iyer. Tell us a little bit about where the demand is coming in from and if the growth is sustainable going forward or not.
So clearly we are seeing demand holding up. Footfall at the dealerships are very, very good, and that is benefiting us clearly. We are gaining market share in most of the product that we participate in, and that's the other reason why we see this kind of a loan book growth. Also, we believe going forward, there will be a price increase announced by various OEMs over a period of time. And even for the same volume, you will see better disbursements. Put all of this together, I think definitely we continue to believe that the AUM will keep growing the direction that we are seeing.
This quarter is the fact that your operational expenses have declined quarter on quarter, and that has also helped the operating leverage to kick in. Going forward, what could be a sustainable or a normalized run rate for the OPEX cost?
No, so clearly it will not be the same number going forward. Our OPEX is little variable with volume. As you know, in the third quarter, we didn't have too much of repossessions of vehicles to be done, and the cost of that repossession definitely does not come in here. And two is you've seen one-time movement of our employees who were from the staffing company. We moved them to our payroll, and therefore they shifted from the overhead part to the employee cost part. So therefore you see some dip, but clearly we are investing sufficiently in our technology space, in our digital space, and therefore we will be opening more branches. So this would not be the level, but definitely we do believe that from the past of about 3.15 as a percentage of overhead to the asset is over a period will come down to at least about 2.7, 2.8 kind numbers.
And your ROAs are at about 2.1%. You plan to be at about 2.5% by FY25. How confident are you, and what are the levers that will help you get there?
So clearly 2.5 was our 2025 target. And the way we are today, we do see that it's catching up and we will definitely be able to reach there. We don't have doubts on that. If you ask of the various levers, we just talked about the OPEX. We do believe about 30 basis point saving in OPEX should help that cost big time. Our credit cost is very, very much under control. And we do believe that the credit cost is the other lever from where you will see this happen. Nims are being maintained. Put this all together, we don't have a doubt that 2.5 is reachable by the time that we have set for ourselves as a target.
Right. Mr. Iyer, great to have you on ET Now. Thanks as always for taking the time out and speaking with us today. In fact, on that note, we're going to wind it up on this edition of the Market and First Trades. We'll leave the market